Good morning. This is Ken Long from Tortoise Capital Management with the review of the weekend trading report for February 13th, 2016. Our market condition remains in bear volatile. On an annual basis, using weekly RSI 14, we are at the very low end of neutral at 38 out of 100. The threshold to go into oversold conditions is 30, which would mark a significant intermediate low when it crosses back above 30. So to go below 30 and come back above 30 would be an important long-term signal. We're starting to approach that critical level. On a 10-day basis, using 10-day NDX, we are at the low end of neutral at 41 out of 100. Considering market mosaic, price with respect to the 200-day moving average is red bearish at minus 7.49%, so we're 5.5% below the threshold for entering a bear market. Slope of the 50 is red bearish at minus 1.15%. That's the worst I can remember seeing in a couple of years. ADX is strongly trending to the bearish side at 31.6. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX. The threshold between risk on and risk off is 1.0. The current reading is 0.969, so we are into risk off. We take that score, compare it to the last 5,000 trading days, find the average and the standard deviation. We then compute the risk Z score, which right now is minus 0.43%. That means we're 0.43 standard deviations below the long-term average. You can see a 90-day histogram of that indicator here. We have been making successively lower lows in the statistical computation here of the risk Z. Each time that we've gotten back to the zero line, it's failed and failed further, and this held true this time also. Didn't even get into the positive, it looks like, and we have just begun the next leg downward. That is a warning that more volatility lies ahead. When we're in this condition, our timeline gets shortened. We're looking to take advantage of intraday large range moves in either direction. We restrict our swing trades, and except for those that are using markets money for reasons that matter and are significant to that particular trade. You can see the blended month rebalancing current holdings and then the current leaders as of the price computed from Friday. In ETF2, the theoretical model for asset allocation is at 0%. The model portfolio is at 70% with stops in place. Looking at the components of those blended monthly rebalancing portfolios here, you can see only treasuries in the ETF 13 are positive. You can see the pain all across the board. The U.S. small caps in Latin America are now the worst. So this is the first time in a while that ILF has not been the worst, and IWM now causing the U.S. some grief here. In the ETF 32, gold, treasuries, utilities, consumer staples, and the short-term treasuries all above their 4-month average, which is why they're on the buy signals. At the bottom of the stack, the energy, the BRICS, Brazil, China 25, all eclipsing the Russell small cap. In ETF Max, all of the symbols that are dominating right now are the short-term interest-generating funds, or those that are tied to volatility. No surprises there. In the S&P 500, there are some interesting possibilities here in the real estate area. Kellogg's, Baxalta looks to be interesting. Newmont Mining, that's kind of interesting one too. It's looking pretty positive here. In the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back, and here's the 60-day mark. The horizontal purple lines are price targets that were once support and are now resistance, and then become the ladder of price targets on the way back up should we start climbing. So if we find support here at this double bottom, first target back to the Bollinger Band mean here, far side of the river, far side of the floodplain, Z plus 3, and then a retest of the previous swing high at 211. On the downside, looking for support at 184. Then 181. If it falls below 181, it's Katie bar the door. We're over 10% sold off still from that swing high. About looks like 3.5% off the swing low. The jaws of PPO have opened to the downside. Um, we're just coming out of over sold conditions here on Williams percent R. You can see how strong the ADX trend for the bears is. We've actually had some recovery here in the slope of the 30-period regression line, which is back up now to about minus 0.4. Still in negative territory, but this rapid fail here has leveled off a little bit on the 30. You can see the 30-period regression line and channel here in black. That's the regression line, that's the channel. So the 10 and the 30 are both facing downward. Again, this is just a typical bear volatile market that has lots of large range days. You can see even in the days that end up as dojis just how far price is traveling. So there's lots of intraday churn going on. No overnight trend really developing yet, and so this really favors the short-term trade until we get settled in into a direction. For right now, I'm trading 181 as a successful test of support here. And again, but the next target only up to 191, so this is certainly one where I'm taking it one day at a time. ETF2 report, all of the regions below their 4-month moving average, so it's cash. The S&P at 44 is better than the globals of VFA at 39. Inside the U.S., it's large caps, tech, mid caps, small caps. The two strongest sectors are the S&P, and then interestingly enough, Asia less Japan. And the two weakest sectors, Latin America at 36, and then the small caps at 36. Inside the U.S. sectors, it's staples and utilities doing well. World market model, Malaysia, Indonesia well above average, along with gold, silver, treasuries. Corporate bonds and real estate also above average. Only the Dow and the S&P above average for the U.S. Everything else now starting to suffer. Same in Latin America, the Western Hemisphere, Europe, and European countries. I should say also the staples and utilities, the defensive plays are echoed in the global markets as well. The ETF top 30, according to the ETF2 model, gold miners continuing to dominate here, along with treasuries and consumer staples. Those that are green and white, that are newcomers to the list here, all related to gold, silver, Malaysia, the euro. Looking at the components of the Dow, Boeing and American Express at the bottom. Boeing is red and yellow, so that's joining the race to the bottom here. Otherwise, Verizon, McDonald's, Walmart, Procter and Gamble, and Coke firmly entrenched in the top 5. ExxonMobil, 3M moving their way towards the top. Microsoft and GE, as white and green, are starting to fail. Travelers and Home Depot, DuPont in the same boat. Cisco on its way back up, white and yellow. ETF liquidity. These are the top 30 based on daily dollar volume. It's interesting to note here that technology, the Qs, have now overtaken the small caps in terms of daily dollar volume. Just note how volatile the VIX is, along with gold miners and biotech. Shifting to the daily report for Tuesday. Plenty of symbols to choose from on the auto framer. You can see volatility is decaying a little bit, but is still at more than one standard deviation above the 100-day average. Handful of dojis in the Dow have a overreaction short in Cisco. So if that's a dead cat bounce and starts to fail, that might be a continuation play for you. Or actually, I should say a reversion to the mean. Lots of auto framers to choose from, along with some 551Ws. Walmart, this would interest me. Walmart, Verizon, Procter and Gamble, and Caterpillar all have been reasonably strong, and they're showing well on the 551W. For instance, when I look at Walmart, I see that he's got a frog number of 3.4, and then on a 1 month and 3 month basis, it's been really standing out compared to its peers, as has Verizon. Notice that on a 1 month, 3 months, 6 months, it's been dominating. So strong relative strength, and the same thing with Procter and Gamble has been dominating on the longer term. So those are three relative strength leaders that all showed favorably on the 551W and could be eligible for some value plays. Again, I would take that one day at a time. I wouldn't go into them as a swing trade until I had made some money intraday and could use markets money. Inside the ETF 30, just one doji here in ag, a couple 551Ws, Latin America and Brazil, and then just about everything testing out well on the auto framer. And here are the computations for the auto framer in the regression line. Fractal framework, these on the top shelf in the green. These are the deep value plays, the symbols that are the most number of their ATRs below their own RL270. And this is how many of ATRs. So as you read this, American Express is 9.25 ATRs below its long-term fair value. Those on the bottom shelf in the red, these are overheated, if you will, or the relative strength leaders. This is how many ATRs they are above their RL270. So it's extended, if you will, in Walmart to 5.65 ATRs above its long-term value. So as I look at these, I consider them as candidates for value plays on the top shelf once I see the RL10 turning. And on the bottom shelf, these are the ones that I'm looking for continuation momentum plays, but also potential reversion to the long-term value if their current strength begins to decay. So if I have positions in any of these, then I'm looking for ways to make sure that I protect the open profits. These are the daily squeezes. These are the ones that, if we just take mechanical entries, they are postured for relatively large one-day moves on the basis of recent price activity and ranges. Right. So the range is less than 0.7 of the average range, so that means that the last day was relatively compressed. And yet, when you take that as the risk, the range stat divided by that risk is greater than 2. So that's how you get large potential one-day moves, even using a full range risk as your initial risk. So one that stands out for me there would be Apple, ExxonMobil, Goldman Sachs. All of those look to be interesting. Yahoo, eBay. This is the 30-day regression line, the straight line blue. This black line here is a polynomial regression line that shows how that line might be, the dynamics of that line may be changing and continuing to get weak here. This is the 180-day look at that slope of the 30. You can see it found its support level down here at 2 sigma. Is moving back towards the 0 line. It crossed over its 10 period moving average here in black a while back, and so that quite often is an indicator of a change in regime. So what you get, the price that causes this to occur is this price you can see here in a price with respect to the 200. There was a 30-day period in which this was just horrible, and that's what this reflects here. And then there was one leg up, one leg down, and finding support, and it may actually be finding support here. And so the fact that it's not failing at the same rate as it did over there is why the slope of that regression line is starting to improve. Now, it's not positive, but the rate of fail has slowed down. And that's what this is saying, is when it crosses over its 10 at a distance of more than 1 SD from average, this may in fact be another support level being put in. And that looks like this, the nearest neighbor. The last time it did that was about a 15% gain. Not saying it will, but the potential is being baked into the cake. The slope stat, when we look back 10 years, that negative slope, when it got as extreme as it did, was as bad. It was one of the top 4 bad 30-day periods of the last 10 years. That's how bad it was. And you can see the slope stat with respect to that. This is computing against 10-year averages and standard deviations. So this is a relatively stable posture here. Whereas the one we saw here is computed off 180 days. So if we want to go back and look at a longer term perspective, we'll use 10 years worth of statistics, and you can see how where this shakes out in terms of this was essentially a 3 sigma event down here, as you can tell. The fail stat, I'll just flash through the next sets of stats for you without comment. Gain stat, gap stat, signal to noise ratio. Apple, again, sneaks out at me here, a interesting posture. The volatility of the S&P over different holding periods. Where we are right now is a z-score of minus 1.6 when we're looking at holding over the last 40 days. That current reading is down 10%, and that works out to be about minus 1.6 when compared with the long-term average and standard deviation. Gold and treasuries, really the only things doing well here. U.S. real estate, actually maybe not so bad. See just how bad the small caps have been. The z-scores of 3 regression line slopes of the S&P, and we've already seen a couple forms of that of the 30 here in the black line, but now you can see the 10 found a lower, or a higher low, if you will. The 30 has crossed the 90. The last time the 90 got this bad was back here, and then price recovered a little bit until it made a nice run up to here. That's what this move in price, this move in price turned the 90 from here all the way up to here. The 30 echoed this price pattern, maybe finding support. Let's see. But this is a crossover occurring outside of the normal zone here of plus or minus 1 SD. So yeah, the argument is that from this position, it could look like this, because back here the river had expanded and rolled over deeply and had two legs down and then a nice leg up. Same conditions here. The only troublesome part is that we had higher lows here, we got lower lows here. And so if this were to fail, the trick would be, to me, if we come back over here to about 185, if it fails through this swing low, then there's another this sized leg here, about $15 or about another 8 to 10% baked into the cake if it fails through here. Frog stats, holding stats. Intraday range percentages. Looking at the system quality numbers for the ETF 30, looking at the most recent months. Here, Staples Healthcare in the green. I'm sorry, this is 2 months back. So looking at the last 30 days, the ones in the green are utilities, treasuries, and silver and gold. That's how good they are. If you look back 2 months, just the last 2 months, Staples and healthcare, you can see how they were better 2 months ago than they were this past month. And you can see the things absolutely getting crushed down here in the commodity areas. And this looks at 3 months ago. Then this is the difference between this actually delays the last month or excludes it, and this looks at the 12 months starting from month -2 to -12, and that really gives you kind of the long-term posture, but not including the most current month. And so these are the ones that have been doing well over a 12-month basis. And then these two divergences give you short-term divergence and long-term divergence. And so the short-term divergences are the ones that I find very interesting, along with the extremes, to start looking for value plays. Transportation sector and correlations. Still very, very tight correlation among the indexes, but it may have found its bottom here, starting to differentiate a little bit, meaning that I take that as an early warning that conditions for a reversion to the Bollinger Band mean, back to the river, is possible here, because as money starts cycling into certain sectors that are seen as the leaders, that performance is going to start diverging from that of the broad market. And when we see those are the ones that start looking like potential leaders for the next segment. And in this case, it could be technology, small caps, and another small cap index here. So their performance is actually starting to uncorrelate from the market, but in this case, those three that I just mentioned are actually getting worse. So what that says is that there is specific activity associated with those indexes where they're starting to fail faster. Now, you would get this same kind of unraveling if they were outperforming the market, because they would be doing better. But in this case, they're doing measurably worse, and that's why this measures the correlation, not the relative power. Okay, so that's everything I want to cover from this weekend. There are some signs of potential turning points being started to getting placed into the market here, baked into the cake, if you will. But still, the overriding posture for me is one day at a time, exploit the large intraday ranges, carry no overnight risk except with markets money, and only if there's a reason to believe in a potential swing trade continuation pattern. So, this is Ken Long from Tortoise Capital with the Weekend Trading Report. Keep your risk measured and your powder dry.